When Paytm went public in late 2021, the market delivered an immediate verdict. Its shares dropped over 27% on the very first day of trading. For many investors, this single event defined the company as a failure of the Indian tech boom. That perception hardened in early 2024 when the Reserve Bank of India, the country's central bank, effectively ordered the shutdown of Paytm Payments Bank. By stripping the company of its core banking license, regulators appeared to have delivered a death blow. Yet beneath these highly visible collapses, the business reported 25% revenue growth in the following fiscal year. While the public focused on the loss of the bank, the underlying platform was processing trillions of rupees in merchant volume and moving toward operational profitability. We often evaluate businesses through vivid snapshots of disaster. We freeze a single bad quarter or a regulatory issue in our minds for years. But businesses are not static images. They are entities that evolve through quiet, multi decade pivots that the headlines often miss. Paytm's survival is not the result of a single flawless business model. It is the product of a relentless mutation. Every time a new technology or a new regulation threatened to erase them, they stripped the business down and rebuilt it to outlast the current era. In its earliest form, Paytm was a mobile value added service business. They weren't building financial tech. They were selling ringtones, cricket alerts, and astrology updates to users on pre smartphone telecom rails. This utility created a high frequency habit. People needed to top up their prepaid mobile minutes constantly. By digitizing that one simple errand, the company captured the data and trust needed to eventually launch a digital wallet. The turning point arrived in 2016 when the Indian government suddenly withdrew the country's high value banknotes from circulation. As cash evaporated overnight, millions of people needed a digital way to pay for basic goods. Paytm responded by aggressively pushing simple printed QR codes into small retail shops and tea stalls. A merchant didn't need a card reader. They just needed a piece of paper that allowed customers to scan and pay from their wallets. Sales teams were deployed shop by shop across the country, manually onboarding millions of merchants. The company used a massive physical distribution network to anchor its digital habits into the real world. This era established a core principle of the Indian market. Scaling an internet business requires more than software. It requires building deep physical distribution to support digital growth. But just as Paytm captured the market, a new threat emerged: the Unified Payments Interface, or UPI. Built by the government, UPI made bank to bank transfers free and instant, making proprietary digital wallets largely unnecessary. Because any app could use these public rails, the payment layer became commoditized. Paytm now had to compete for merchant counter space against global giants like Google and deep pocketed rivals like PhonePe. The economic reality of this system is brutal. These platforms process billions of transactions, but because UPI is a public utility, they earn zero margin. To survive, Paytm pivoted to hardware. They introduced the Soundbox, a speaker rented for a monthly fee, monetizing free payments. In a noisy, crowded market, the Soundbox provides an instant audio confirmation of payment. It functions as a trust device, giving the merchant immediate proof that the money has arrived without them having to check a phone. When the software layer became free, survival required a mutation into a hardware business to physically lock in merchant relationships and build a recurring revenue stream. At its peak, the company tried to own the entire financial stack by launching its own bank. The goal was to hold customer deposits and control the back-end infrastructure directly. But rapid scaling outpaced their internal controls. Regulators noted persistent compliance failures, leading to the business restrictions that eventually forced the bank to close. This forced an urgent unbundling. The consumer app was severed from the banking infrastructure, rewiring operations through third-party partners. This asset-light rebirth uses payments to acquire users, acting as a distributor for partner bank loans. They collect connection fees while partners take the risk. Simplifying the business revealed that monetizing a distribution network carries lower risk than attempting to own the regulated banking infrastructure itself. The modern digital economy operates on two distinct levels: distribution and trust. A consumer might habitually use an app daily for trivial payments because it's convenient, but that convenience does not automatically translate into trusting that same app with their life savings or a large business loan. While digital platforms now control consumer attention and merchant discovery, the financial weight still resides with traditional, highly regulated partner institutions. Business survival requires constant mutation. Capturing the distribution network was the prerequisite for Paytm to stay in the market. The ongoing battle is whether they can convert those daily habits into the genuine trust required to own a customer's financial life.